Hey everyone, welcome back. If you're new to the series, for this one, it's just me walking through how I come up with a valuation for a company, kind of start to finish. First, we look at the 10K, pull in information from the income statement and the balance sheet out of their financials, forecast out kind of top line growth. I think that's usually the most important thing to spend the most time forecasting on. And then we look at linking up the DCF. So if you've ever downloaded one of my models and just curious where these numbers come from and how I think about it, where I pull them from, talk through that. And then in this video now, we're going to kind of finish out the projections here of the valuation and hopefully come to some sort of valuation and see what we're getting at. So the first thing down here, right, COGS is a percent of sales. So if you watched the last video, you know we actually backed content amortization out of COGS because it's basically DNA. So if we're trying to get EBITDA, we need to back that out. So what we actually need to do right now, we have G6 divided by G4. So we need to update this slightly. For most companies, this would hold true. You could probably just leave it as that, but we'll do G6 minus G5 divided by G4. So this gets us kind of the actual remaining cost of goods. And I'm not surprised that this is super low from that standpoint, right? So this is really like probably like the infrastructure, data centers, things like that to kind of keep the company going. Um, and maybe this isn't the right place to do this because we are gonna, I mean, we're not, I guess we are gonna forecast out content amortization, so that will link up there. Um, so I guess we could have left it the other way, but it just gives us a good picture of the COGS excluding amortization of, so right, like if they don't purchase any new video content and they just keep what they have, right, they could just become incredibly profitable overnight. Like just cut that, right? Boom, zero. The question is like, would people stay on the platform if no new content was added? I don't know, probably not. But so anyways, we'll do that. But actually, now that I'm thinking through it, let's remove that because the way we have the content amortization we'll change that here in a second. So my base case is I usually just kind of hold this constant. I think it's hard to make assumptions around cost of goods sold unless if you know something specific to the company. So what I mean by that is like if you're looking at, for example, um, like Rocket Mortgage, um, or what's an even more like a Walmart, like right, their cost of goods sold is probably going to remain pretty steady, and like unless if it's like a highly like has a lot of operational leverage. And so, for example, right, like you could make the argument that Netflix, the more users they have, the more revenue they have, the less their COGS is. And we can kind of see that here actually, right? Revenue's been increasing and COGS has been going down. The idea behind that for a company like Netflix is like you only have to add probably a fixed amount of new content every year. And in their case, it looks to be, what are they adding? 12 to 14 billion dollars of content a year. And as long as you add that amount of content, like you probably cover enough content for just about any person on the planet to want to sign up. So like that number is not going to be going up. And then on top of that, um, this business scales well, right? Like to have a new customer sign up doesn't cost them anything extra. So, maybe leaving this flat actually isn't the best. Um, so maybe we'll stick with the trend and we'll have it going down 1% a year. Um, and that we might get something like crazy here. I don't know. We'll see how it all kind of plays out. And then we'll link this up, right? So for this, really what it is it's revenue times this percentage. So what we're saying here, right? COGS is a percentage of sales. So percentage of sales, right? We just multiply it across, get our number, and we can see, right? Like COGS is still increasing significantly. And we'll do a sanity check after we figure out content amortization. So we do a sanity check here, right? And it's like, okay, COGS is still growing, makes sense. Revenue is doubling, but COGS doesn't quite double. So that probably makes sense if we're saying they have a decent amount of leverage here in their business. So um, next part, and we'll come back to this last. So I just took a basic template I always use. Normally I probably would have structured this a little bit different if I wasn't thinking ahead about this piece. So we'll touch on that here in a little bit, but we see, right, SG&A as a percentage of sales, 19, 18, 13. Maybe this dropped a little bit this year just from office being closed, people working from home. You don't have as many expenses related to that. Um, I don't think they furloughed people or did pay cuts, but um, I don't know because that's a big drop, right? 18% to 15%. You actually decreased SG&A. Will that come back? I don't know. Um, so I'll probably actually just do an average here and then hold it at 17. The reason being is like what you don't want is you don't want to assume that like whatever this is, because they didn't talk about it in the 10K of like what's materially driving this decrease. And I actually do remember it. Now that I'm thinking back, they did say their marketing costs, which if we remember our SG&A, we have it linked up as marketing and G&A. So their actual G&A expense goes up, but their marketing went down. And they said the marketing cost was going through a what did they call it? A marketing they basically moved their marketing from in-house to out of house. So actually, maybe the 13% is correct, and my guess is maybe those additional marketing costs are actually being layered into COGS. Um, so maybe the first one we'll leave it at 13 for now, and we'll just kind of see what kind of valuation we get and if it's something crazy or not. Technology and development, right? This is 7 to 8%. Doesn't seem like it fluctuates much. Probably a pretty fixed cost as a percentage of revenue. I guess I left that as an average. Just like that actually. Just kind of hold that flat. There we go. Tax rate 21%. That's the current corporate tax rate. Obviously, you could do some big tax analysis and think they're going to perform better or not. I usually don't do that just because. So now next part, CapEx, right? CapEx is a percent of revenue, 1 to 2%. Nothing super crazy. I guess this is really just like headquarters, things like that. So we'll just kind of leave that as a constant percentage is how it's been historically. Depreciation. So, right, this ramped up really high here. So depreciation was low, but before it was about 50%. So they had been investing quite a bit in their offices and everything. So maybe we'll do this and just add 5% a year until we get to like 80. I think 80% is usually like we don't even get there, but that's fine. Just leave like that as it kind of scales. And then content purchase amount of revenue. So this is a hard part. And I think you could do a whole analysis on this piece of the business, right? How much content are they going to have to continue to purchase every year to continue revenue growth? And right, so they've been purchasing 13 to 14, I mean, I guess 11 and a half to 14 billion. And I don't know how that scales. Did I pull the numbers historically? Right, 8.6 billion, 9.8, 13, 14, 12. So I mean, right, that's averaging 11.5 over the last 5 years. They're probably going to have to continue purchasing something similar like this to keep the growth, to keep new customers interested. So my thought is maybe let's add. In this first one, I'm actually just going to set this to like 12 billion and then have that grow slightly with revenue. Maybe I'll do, maybe I'll have it grow at half the rate that revenue grows. I don't know if that's really like a fair assumption, but like obviously you can't grow your costs at the same rate that your revenue grows, but it's not going to be static or flat. It is going to continue growing. And I mean, even this seems a little, I divided by 23. That's why. Um, maybe I think that, that might be reasonable. My thought here is like, right, you're going to have to continue to invest in new and more content and original content to get people on your platform. If revenue is growing 11%, right, revenue needs to grow faster than the growth of your content acquisition. Otherwise, it's just never going to make sense financially as a company. So we'll do that. Let's see how it looks if we actually take this formula now. 45. So we have it really just going down from current levels of 47%. But obviously, revenue's growing, so we'll see. There might be a better way to model this out. Love to hear your thoughts below if you have a different thought here around how to kind of handle that. And then the amortization piece, right? So historically, but then it goes up to like 90%. So my guess is it's actually going to stay high because we have a lot of historical stuff that we're amortizing over the years. And I guess another sanity check real quick. They mention in the next like 3 years, they're going to have probably like 1 to 4 billion of additional unknown um, content acquisition. They mentioned that in the 10K. So if we're at about 12, right, and then we're adding, you know, 1, 2.5, 3, we're adding about 4 billion across those 3 years. It's probably fair in comparison to the baseline we're at. So we'll hold the amortization piece flat for now, and that's as a percent of content purchase. I actually think we need to make that negative, so we'll do that. Now we should be able to link everything up. So SG&A, right? We have this as a 13% as a percent of revenue. Link that up. And honestly, I have no idea if we're going to get anywhere close to their valuation. For some reason, I'm feeling like we're not, which is worrisome. Makes me think we're going to have to assume much stronger top line growth, but we'll see. So amortization of content. This is just linked up to here. Link that up. Take this formula now. Let me make sure these formulas are all synced up. Yep. Okay. Amortization of content. And let's see, how does that turn out? Adjusted EBIT. Why is that so high? Because that's not the right formula. There we go. So most of that looks good until we see this piece, which we haven't adjusted yet. I mean, if we hold it constant, we're actually going to see like pretty much nothing. So I think that's good. And what net working capital turns, I don't think I've gone over this yet. It's so if we look at this H4 revenue divided by your working capital, it's a ratio that's used. You could also look at like current assets or current liabilities as a percent of revenue or something like that, but easy enough proxy. And I don't like to have material cash flows from your working capital because that stuff can always just be kind of gamed or changed. So there's that, right? WACC, you can obviously change this to whatever you're most comfortable with. I think Netflix is a pretty strong company that's not really going anywhere. I don't think it's super risky. Probably give it like an 8%. It's not. I don't think Netflix is like going bankrupt or going away. I don't think they're going to have like a super big regression of revenue. And this is really like the return you would require. So, I mean, you could kind of pick what you want there, but we did like 8, and then if you sensitized it from 8 to 10, something like that. And then terminal growth rate, right? So can't really be higher than the rate of inflation, otherwise you get like crazy stuff. So I usually pick 3%, which is right at about inflation. So, based off this, depending on how much of a return you require, 74 to 224 billion. If we actually pull up their stock price, I don't even know what they trade at. I'm guessing much more than this. I think they're probably like a $200 or $300 billion company if I had to guess. 240 billion. So I mean, if you're, don't need a super big return, which is probably not realistic, probably fairly valued. So, and this is our first revenue assumption, so we'll change that. I'll actually copy the model over. We'll call this like DCF country level. So this is our country level assumptions, and all we have to do here now is just update this. So these ones were linked to this total revenue, the first ones we made. If you watch that video, this one needs to change, not the historical. There we go. We'll see. So yeah, I mean, at the country level, right, you get 144 billion, and we could even refine this more, right? You could go look at average monthly revenue per paying membership, right? We had it holding flat for a lot of these, so you could obviously assume more growth on some of these aspects, um, or you could come in here and look at the content acquisition costs. I mean, I think that's what's hard about this is like to keep the user growth, and especially with how many um, or how much competition there is in the space, I think they are going to have to continue to invest heavily. But this might actually trail off going forward. And my thought here is they've moved to an environment of producing content in-house. So, realistically, maybe it kind of caps out at about 13 billion. Like maybe it doesn't actually scale all, you know what I mean, all the way up to 18 billion. So maybe you really do have something like this, um, and then you have it kind of go from here. And as you build up your own library where you own, all this content, it actually gets cheaper every year, $500 million or something. And then, regresses back to kind of like a 10 billion, but then you just have this huge historical library of content. In that kind of scenario, right, you're getting anywhere from 98 to 300 billion, just depending. Um, so, I mean, I think this is a good starting point. I don't think that this is like the answer for what Netflix is valued at. I think you could come in here, you could refine the revenue projections. Another thing you could tweak here, um, you could say, no, as they grow in these countries, they're going to be able to grow, maybe not 5%, maybe 3%. They're going to at least get inflation. They're going to get inflation for all their business lines. Like they're not going to continue selling stuff cheap. Like, and they're going to get inflation. And I'm sure, what do we have here? Faster than inflation in EMEA and in the US. And, maybe in the US they can even be more aggressive, right? Like we want our Netflix. I'm gonna be paying $30 a month by 2030. So maybe 6%. Let's do that. 7%. Like, right, like you could make the argument like they're gonna just come really take advantage of US consumers. Something like that, right? Now you get, 170, 200. So, and if we go back to our other DCF even, I mean, now you're getting 225. So you're still getting there. Um, I guess this one doesn't take into account here. So we would have to adjust revenue per month. Here I actually have revenue per month per user decreasing because I just assume as they add more users in the lower places or the cheaper countries, um, they erode margin, but maybe they hold it constant or something, right? And now you're getting 240 on the highest end if you think there's no risk. Um, so yeah, I think there's a lot of things you could play with in this model and this valuation. Definitely download it, take a look through it, make some adjustments to your assumptions, but hope this helped kind of just understand how I go about pulling together a valuation. And to be honest, for my personal investing, I stick to industries that I'm pretty familiar with, which I know a lot more of what's going to drive kind of the top line and stuff like that. I think on something like Netflix, do a little bit more research on just understanding kind of subscription prices for consumers in these different countries, right? Like maybe in EMEA, there's services that are $30 a month and a lot of consumers have it, and you're like, they just have not been adjusting their pricing appropriately, and they could. Um, LATAM, right? Like maybe, there's no other competition there. I don't know, right? Like, so you could go in and try to adjust some of this stuff and come up with a better valuation. But I think they're probably fairly valued. Um, they're definitely they're priced as if they're going to continue growing and continuing to be kind of the leader, them and Disney probably as like the leaders of streaming. Um, so as long as that kind of holds true, I think it's probably a pretty good play. But I guess time will tell. And yeah. If you have any questions or comments, leave them below. And thanks for tuning in. I hope you found this little mini series helpful for how I go about throwing together a valuation.